Volume versus liquidity, the crucial factors traders overlook for successful trades. Most traders are unaware that volume and liquidity might just be the most important factors when selecting a trade. Have you ever wondered why your buy orders or your sell orders get skipped? Is it due to volume or liquidity? In this video, we're going to uncover the crucial role of volume and explore the different types of liquidity. By the end of this video, you're going to have the information most traders lack, giving you the upper hand to make successful trades. While liquidity and volume are related, they're not the same. Volume is a measure of trading activity, while liquidity is about the ease of trading. High volume can contribute to high liquidity because more trading activity usually means more buyers and sellers are available. So first, let's start with volume. What is volume? Volume measures the amount of crypto or the asset that has been traded over a specific period. It's kind of like receipts, buy receipts, sell receipts for the market. It's something that already happened. Now, this shows the level of activity and interest, or lack thereof, in a particular crypto or asset. High volume often indicates strong market interest and potential price movement, either to the upside or the downside. Most traders ask this question: why is the volume low but the price is going up? I go over this in greater detail on understanding what volume truly is and how to use it to your benefit in this video. But to summarize it, low volume with higher price action means there are fewer traders, which is volume, but they are willing to pay at a higher price. And this causes the price to continue upward while the volume is low. Now to answer the question, what is liquidity? Liquidity refers to how easy it is to buy or sell an asset without causing a significant price impact. Smart traders look for higher liquid markets to ensure their orders are filled quickly and at a desired rate. You can only sell to someone who's willing to buy, and you can only buy from someone who is willing to sell. Liquidity also helps in better price discovery, meaning the prices reflect the true value of the asset based on supply and demand. Now, if you're on a centralized exchange, also known as a CEX, where there is low liquidity, and that again is the amount of tokens that you're trying to buy or sell, for your order to be filled, if you're buying, you may have to pay a higher price or have multiple buy orders. Now, if you're selling, for example, you have 3 targets, but the liquidity, buyers in this case, is very low. Even though your targets hit, your orders may not be filled because, again, you're trying to sell to a buyer, and if there's fewer buyers, your order may not get completely filled. So then you may have to increase your targets from, let's say, 3 to maybe 7 or more, depending on the amount of tokens you're trying to sell. And all of this is displayed in the order book. Now, I also have a video on how to understand the order books and why it's crucial for every trader to understand. So make sure to watch this video where I talk more about this topic in greater detail. So in short, high liquidity means faster trades with minimal price changes. And then, of course, if you want to do the monthly with a credit card, it's right here. It's $99 a month. And of course, you get all this stuff. And then, of course, if you want to do lifetime, here's a lifetime. Here's a lifetime. Now, if you want to pay with a crypto, then just send me a message on Telegram. Now, let's talk about liquidity on a DEX, a decentralized exchange. So one of the main differences in understanding liquidity on a DEX as opposed to a centralized exchange, on the centralized exchange, you can actually see all of the buyers and sellers in the order book. For the decentralized exchange, also known as a DEX, when you have low liquidity, this can lead to higher price volatility and slippage, where the price changes between the order placement and the execution or finalized transaction. A very common question that most traders ask is, how does the DEX get liquidity? Well, the decentralized exchange gets liquidity primarily through liquidity pools and liquidity providers, also known as LPs. Without going too much into detail, because this video is already pretty long, there are 3 main factors. One is the liquidity pool, and all this is smart contracts where users deposit pairs of tokens. And this creates a pool of funds that can be used for trading. The second one is liquidity providers, which is LPs. And there are users who contribute their assets to these liquidity pools. And in return for doing so, they get a small portion of the transaction fees that are generated by the trades within the pool. And then last, of course, you have the AMM, which is the automated market makers. And most DEXs use the automated market makers to set prices and facilitate trades. So why is all this important? Well, liquidity is important when trading on a DEX because 1, it reduces slippage. 2, it stabilizes the price. 3, efficient trading. So with higher liquidity leads to faster order fulfillment. 4, we have lower transaction costs. Next, we have market confidence. Whenever there's higher liquidity, it indicates a healthy and active market. And then last, and probably the most important one, is risk management. Understanding liquidity helps traders manage risk more effectively by avoiding markets with insufficient liquidity that could lead to unfavorable price movements. And I'm pretty sure I'm gonna get this in the comments. Like, what is slippage? Slippage for a DEX refers to the difference between the expected price of the trade and the actual price in which the trade is executed. Now, for DEXs such as Uniswap, PancakeSwap, you're able to go into the settings and adjust your slippage. It's always recommended that if you do use a DEX and you're unable to get your trade fulfilled, go to the project's Telegram, check their pinned messages, because they may say you need a slippage of 5%, maybe 10%. That way your order can go through. Just keep in mind, the higher the slippage, the more you may pay for that token. And here's a pro tip. To minimize slippage, you want to trade when there's high liquidity, when there's a lot of traders. By doing so, you're going to reduce the impact your trade has on the price. Now, moving on to liquidity grabs or liquidity zones. It is often referred to when there's a lot of buy pressure or sell pressure. In this case, this is a resistance zone illustrated by the wick, but this is also called a liquidity grab. And since we have a zone right here, we have multiple ones. And the way you can label this as a liquidity zone or liquidity grab area is you want to go from a candle body close to the top of the wick. And this just tells you that there's a lot of sell pressure right here. So if the price action does come up, we have a pretty high probability that it may come down due to this liquidity zone or liquidity grab. Now, the same can be said for stuff on the bottom. This would be a support zone or another area for a liquidity grab. This means there are potential buy orders sitting right here, so that if the price were to come down, we have a higher probability that it may come down and revisit this zone to fill up some more of the buy orders that may be sitting in this area. Same thing as when the price comes up here, we may have a lot of sell orders that are sitting in this area. And finally, we have the heat map. This shows you areas of liquidity. So this is where a lot of people have sell orders, and underneath the price action, here are your buy orders. So if the price action comes up here, and you can see by the color grade, the higher it is, the brighter it gets to yellow. This is saying that there are a lot of sell orders at this area right here. And there are a lot of buy orders at this area right here. Now, the heat map shows orders that have not been filled yet. These are buy orders and sell orders. Depending on the amount of orders could potentially drive the price up or down. It is also important to know that these orders can be canceled at any time. And the whales know that retail buyers and sellers, and we are the retail buyers and sellers, we have access to this type of information, and they could easily set orders and cancel them at the last moment to trick us. So just because you see sell orders here or buy orders here, that does not mean that when the price goes here, it's going to stop. Or if the price comes down here, it's going to stop. Knowing the difference between the concepts of liquidity, volume, order book is the key to making more informed and successful trades. Liquidity ensures you can enter and exit a trade smoothly, while volume shows you the market's activity and potential trends. So what are your thoughts on liquidity and volume? Have you had entries that weren't completely filled? And also, have you had targets that didn't completely get filled? Drop me a comment below. And if you found this video helpful, definitely smash the like. Everything that I say is from experience. This is what's going to save you so much time, so much money, and so much effort. Like, it's super important. Now, if you're in the VIP, I have videos that are 3, 4, 5 minutes long on average. If you want to make money, I will show you how. I would offer the free group, but it's already full. I have a huge wait list. So more than likely, if I do let 3 or 4 people go, the spots are filled. Not only that, but when people do sign up for the VIP because they're making money in the free group, I am very, very invested to make you money in this free group so you can get the VIP. When those people leave the free group and get into the VIP, well, there's just so many more people that are trying to take their spot. I would strongly recommend getting the VIP. You're going to make money. Now, granted, none of this is financial advice. It's never hopes and dreams and empty promises, nothing like that. See what I do. See if this makes you money. I give you my real life experience based off of my trainings, based off of my teachings, what I would do at that moment versus what everybody else does, because they want to sell you their course. They want to sell you all that stuff. I show you that my stuff works. Do we win? Yes. Do we lose? Sometimes. That's part of the game. But what I do is I show you all this so that you can see, oh man, I lost today, but Joe said he lost too. So it's okay. That's what I want you to realize, guys. If you like the content that I provide, make sure to smash the like button, subscribe to the channel if you're not already, and leave me a comment in the comment box. And I'll see you on the next video. And as always, let's make this money.